In this section, we're going to go briefly over the personal income report produced by the Bureau of Economic Analysis. This report is released to the public late in the month, one business day after the GDP report. Its three main sections are personal income, disposition of personal income, prices or inflation. Now, what is personal income? Personal income is money individuals get for their labor, salary and wages, owning their own business, proprietor income, for someone using an individual's property, rent, and for financial investments, interest and dividends, plus private and government aid. Persons consist of individuals, nonprofit institutions that primarily serve households, private non-insured welfare funds, and private trust funds. Personal income is the sum of compensation of employees, proprietors' income, rental income of persons, personal income receipts on assets, and personal current transfer receipts, less contributions for government social insurance. The biggest component, by far, is compensation by employees. It makes up 2/3 of personal income. It has two major subcomponents: wage and salary disbursements and supplements to wages and salaries. Wage and salary disbursements are simply what businesses pay their employees. This includes salaried income and hourly income. Supplements to wages and salaries are what employers pay for employees' benefits, such as for employee pensions and insurance, and for employer contributions to a number of federal and state benefit and insurance programs. Proprietors' income is income for businesses owned by individuals, including partnerships, rather than corporations, and includes farm and non-farm businesses. Rental income is income to persons from rental of real physical property. Personal income from receipts on assets is made up of personal interest income and personal dividend income. Personal current transfer receipts are income payments to persons for which no current services are performed. Basically, they are Social Security, Medicare, unemployment insurance, federal old age and survivor benefits, food stamps, disability, earned income credits, and a number of other programs, both from the government and businesses. Business write-offs of bad consumer debt are also included. Personal current taxes are tax payments by U.S. residents that are not chargeable to business expense. Personal taxes include income taxes and taxes on personal property. After the taxes, what is left is called disposable personal income. It is disposable income that drives consumer spending in the long run. Personal outlays are what you do with disposable income, other than save, such as buy things or services, pay interest, or make a gift or donation. So there are three major components in personal outlays: personal consumption expenditures, personal interest payments, and personal current transfer payments. Personal consumption expenditures are purchases of things and services used by a consumer. The three major components are durable goods, non-durable goods, and services. Personal saving is simply the income left over after paying taxes and after personal consumption outlays. The initial personal income report has price indexes for overall personal consumption expenditures, the three major components of PCEs, and a few specially calculated price indexes, and the standout being PCEs excluding food and energy. Financial markets see the PCE price indexes as the best measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consumer sector. The PCE price index is the measure of inflation for the consu The obvious shortcomings of the PCE price indexes is that they come out about 2 weeks after the CPI report. The Federal Reserve sees the PCE price indexes as superior to the CPIs. The PCE price indexes are chain-weighted indexes, meaning the component weights are updated every year and chained together. In contrast, the CPI has fixed weights from the base year. The second reason the Fed prefers the PCE price indexes to the CPI report is that the PCE price index is a little more comprehensive in scope. It includes some minor services components not included in the CPI. The bottom line is that the overall PCE and core PCE price indexes provide a better view as to how the Fed sees inflation than the CPI does. Several events can cause sudden swings in certain indicators in the personal income report. An example of one of these special events would be a hurricane, a natural disaster. Another thing that can change and affect wages is the January increase of pay by the federal government for its workers. What also can affect, and is of recent occurrence, is the fiscal stimulus programs. Recently, they have caused sharp swings in personal income using income tax rebate checks. When the personal income report comes out, markets focus on 4 key numbers and the monthly percent changes in overall personal income, the core PCE price index, the overall PCE price index, and overall personal consumption expenditures. During most of the business cycle, gains in personal income are positive for the stock market and negative for the bond market, resulting in higher interest rates. But if the economy is at a turning point, the income numbers could be seen as tipping the Fed's hand to make a policy change in interest rates. So you see, the Personal Income and Outlays Report produced by the Bureau of Economic Analysis is a very useful tool in gauging the health of an economy.